Hi everyone, welcome back to Sean and Shiba. On August 20th, Reuters published an exclusive report saying Beijing is considering allowing a RMB-backed stablecoin to promote wider global use of the RMB. Back in April, we broke down why stablecoins are poised to be the fastest growing form of digital money over the next decade. If the US Senate passes the so-called Genius Act and unlocks a bigger runway for dollar stablecoins, Washington will supercharge this market. Sensing that shift, Beijing now appears to be eyeing an RMB stablecoin to compete for future market share. Today, let's talk about what an RMB stablecoin would really mean and why it faces structural limits. First, a quick rewind. China was once the world's biggest holder and producer of crypto assets. In November 2013, BTC China's trading volume topped global charts. At one point, miners in China controlled roughly 3/4 of global hash power. Around 2017 to 2018, Nvidia's Jensen Huang reportedly flew to Jiangxi multiple times because a giant Ethereum mine there was buying gear at massive scale. Back then, China looked like the future of crypto. Then came the crackdown. In 2017, Beijing declared crypto payments illegal, arguing they threatened financial stability. By June 2021, the People's Bank of China said speculative trading was disrupting the economy and fueling risks like illicit cross-border flows and money laundering. Mining and trading moved from illegal to criminal. China's share of global compute power collapsed from dominance to near zero. Had Beijing not banned mining and trading, China might now be the world's largest crypto supplier, controlling a strategic artery of digital assets, much like it does rare earths. Instead, leadership in digital money and assets has shifted decisively to the United States. This wasn't an accident or a brief lapse in foresight. In tightly controlled systems, disruptive innovations with high uncertainty are often suppressed to preserve order. That's what happened when Bitcoin mining took off. At first, authorities treated it like a tech novelty. But when a Shanghai developer once accepted Bitcoin for apartments, the signal was clear. Payments could move outside the PBOC's clearing rails and the FX regulators' oversight straight offshore. From that moment, the state viewed crypto as a governance risk, not an opportunity. Fast forward 8 years after Bitcoin's birth. In 2017, crypto became illegal in China. 8 years later again, digital assets have become the fastest growing asset class globally, with the US and EU building full legal frameworks for USD and EUR stablecoins. Beijing has woken up to a hard truth. The illegal innovation it crushed has become one of tomorrow's biggest economic platforms. But the early edge is gone. The world's most mature, scalable market for digital assets today is in the US. What does that teach us? When regulation loosens, China's entrepreneurs show amazing energy and competitiveness. But authoritarian controls eventually smother that energy. And here lies the core conflict. Digital money's signature feature is decentralization. Authoritarian governance is built on centralization. If ordinary Chinese citizens could freely use decentralized digital money, their wealth would sit outside tight state control. That's precisely why crypto is inherently at odds with authoritarian systems. So what would an RMB stablecoin look like under Beijing? It will not be decentralized. It can't be, because decentralization would weaken political control. That same irreconcilable tension already crippled the digital RMB e-CNY project. Remember e-CNY's rollout around 2020 in cities like Shanghai, Hainan, Changsha, Xi'an, and Dalian? Despite years of heavy promotion, e-CNY ended up marginalized by WeChat Pay and Alipay. Why? Design contradictions. To be useful, a digital currency needs offline payments. Otherwise, no internet means no money. But true offline capability creates a regulatory blind spot. If you pay and receive entirely offline, those balances can slip past centralized surveillance. Beijing cannot accept that. Remove offline freedom, and e-CNY becomes just another online wallet without the social graph or convenience advantages of WeChat Pay and Alipay. Result, low adoption despite big numbers on paper. RMB stablecoin will run into the same wall. Beijing will almost certainly centralize it, much like the EU's MyCA framework plus the funds transfer rule require verified sender or receiver data for crypto transfers. That design turns service providers into centralized checkpoints. Once you centralize like that, you lose the core benefits of digital money. No true peer-to-peer finality, no radical cost cuts from removing middlemen, and little speed advantage over today's bank rails. You've simply shifted the bank role to licensed crypto service providers, still tightly regulated. Now let's talk demand, the other hard constraint. Who actually needs an RMB-backed stablecoin? Buyers of Chinese goods, in theory. But onshore, China has capital controls. That means only offshore RMB's CNH could realistically back a cross-border RMB stablecoin. If an offshore RMB stablecoin pays a mainland merchant, the funds must still be converted and settled through China's banking system or a government-approved clearinghouse before the merchant gets onshore CNY. That reinserts friction and cost, erasing the stablecoin's efficiency edge. Alternatively, keep the RMB stablecoin offshore only. Then the market depends on how much offshore RMB trade actually clears in RMB rather than USD. Right now, that's a niche compared with dollar trade. Bottom line on demand. A non-freely convertible currency makes for a constrained stablecoin. Either you give up the stablecoin's competitive advantages or you give up market share in global settlement. By contrast, USD-backed stablecoins deliver low fees, fast finality, and price certainty without the volatility of pure crypto, and are rapidly embedding into trade and investment flows. Over the next 10 years, dollar stablecoins are likely to gain the largest share of real economic usage, further entrenching US monetary power and sidelining the RMB. Beijing sees the risk of marginalization and wants to act. But the system's own DNA, tight supervision, non-convertibility, and centralized control conflicts with the traits that make digital money win. So the likely outcomes for an RMB stablecoin are two. 1. It stalls like e-CNY, or 2. It launches but fails to change the broader trend toward dollar-denominated digital settlement. Remember, the real core of the crypto revolution isn't just decentralization or encryption, it's freedom. The freedom to move value at the speed of information. That freedom accelerates global information and trade flows, pushes capital to higher productivity uses, and moves us closer to the economist's ideal of optimal resource allocation, which is why digital money and digital assets are set to drive a new economic wave, one that weeds out authoritarian, closed models over time. If Beijing truly wants an RMB stablecoin that matters, start with step 1. Make the RMB freely convertible. Without convertibility, an RMB stablecoin is a castle in the air. Let's see if that first step ever comes. That's today's breakdown. What's your take on an RMB stablecoin, viable challenger, or dead on arrival? Drop your thoughts in the comments, and we'll see you in the next video. Sean and Shiba, see you soon. Ciao.